In today's uncertain economic climate, more and more investors are turning to the safety and stability of established dividend-paying companies to stabilize their portfolio and see them through these troubling times. The term Dividend King is a term used to describe companies that have raised their dividend payout for 50 or more consecutive years. That's longer than I've been alive, and in that time they have never once failed to raise their dividend, regardless if the economy is doing well or doing poorly. Because of this, Dividend King stocks are highly revered and can generate positive yield even in a turbulent market. So today we're going to explore the current 5 highest dividend paying kings. Coming in at number 5 is Federal Realty Investment Trust, stock ticker FRT. When it comes to REITs, FRT is the undisputed champ with 55 consecutive years of increased annual dividends. FRT currently pays out a 4.4% yield. Founded in 1962, it owns properties in many of the most competitive real estate markets in the U.S. Primarily focusing on owning shopping centers, FRT also operates in redevelopment of multi-purpose properties, including retail, apartments, and condominiums. Holding a portfolio of 103 properties, 76% of their rent comes from the retail sector, with office space and residential both comprising 12% each. While shopping centers as a whole have struggled given the rise of e-commerce, FRT does have several competitive advantages in the space. The location of their shopping centers are in much more premium locations compared to their peers, both in terms of average income of the surrounding population as well as the population density. Being surrounded by a large population of wealthy residents gives FRT properties the ability to attract premium clientele. In 2022, funds from operations came in at $6.32 per share, up 13.5% year over year, which came as a result of the increased occupancy rates overall as businesses started to revive from the effects of government shutdowns. Occupancy rates increased by 170 basis points year over year and currently sit in an average of 92.8% occupied. FRT also increased the contractual rent increases of its tenants to 2.25% annually. This, combined with its $730 million investment development pipeline, should deliver incremental income for years to come. With current prices sitting around $94, FRT may present an ideal buying opportunity. With a current forward price per funds from operation ratio of 16.8, the company is also trading meaningfully below its 10-year average enterprise multiple, indicating that you can now pick up additional shares of FRT for historically low prices. Coming in at number 4 on the list is Leggett Platt, stock ticker LEG. Leggett Platt is an engineering products manufacturer. They make stuff. The company's products range from furniture, bedding components, store fixtures, die casting, industrial products, and most everything else in between. Fourth quarter earnings were posted last month, with the company reporting revenues of $1.2 billion for the quarter, which represents a 10% decline compared to the prior year's quarter. This, however, was no surprise, as analysts were predicting this decline as consumers scrambled to purchase goods as we exited the pandemic. And now macro trends tend to have consumers a little more worried and are tightening their spending budget in anticipation. Most analysts believe that the company is fairly valued, so unlike FRT, you won't be able to scoop up shares of this stock at a significant discount. But with a forward dividend payout of 5.7%, this has the makings for a solid addition to any portfolio. Number 3, 3M. 3M sells more than 60,000 products that are used every day in homes, hospitals, office buildings, and schools around the world. 3M recently made news with the announcement that it will spin off its healthcare segment, which is big news considering that sector itself generates over $8 billion in annual sales, with this transition expected to finalize by the end of 2023. As with many of its peers, 3M is anticipating a slowing demand for its products given the current economic climate, and is expecting sales to decline by as much as 15% in the coming quarter. As such, the company recently announced it was cutting 2,500 manufacturing jobs. But there is some good news. 3M has been embroiled in a legal battle over noise-reducing earplugs the company had previously manufactured and sold to the military. However, the Pentagon recently released a report stating that many of the plaintiffs involved in the class action lawsuit showed that most of them had normal hearing, thus greatly reducing any potential damages once this lawsuit eventually concludes. While share prices have dropped over the past few years, that is often the best time to buy, as you can purchase more shares per dollar invested. That is, of course, assuming the company's fundamentals are strong, which at 64 consecutive years of dividend increases, I wouldn't bet against this company in the long term. With a current price to earnings ratio near 11, that indicates 3M is selling at a relatively low price when compared to the long-term market average ratio of 15. And the 10-year PE ratio of 3M has averaged about 19.8. This low PE ratio indicates a phenomenal price point. And this, combined with a strong forward dividend yield of 5.75% annually, makes this an attractive pick for many. Number 2 on the list of highest dividend yielding kings is Universal Corporation, stock ticker UVV. Universal Corp is the world's largest leaf tobacco exporter and importer. The company acts as an intermediary between tobacco farms and the companies that manufacture cigarettes, tobacco, and cigars. Given the nature of its business, Universal does not need to invest large amounts of money back into its business, which allows for a substantial amount of its cash flow to be processed as dividends or stock buybacks. With the overall sentiment of the tobacco industry shifting dramatically in the past few decades, as a result, many people have predicted the eventual complete collapse of the tobacco market. However, looking at historical gross profits for Universal, we can see that the company has averaged right around $400 million in annual gross profits per year for the past 10 years. While tobacco production in the United States has tapered over the last few years, global production has remained relatively stable. If the tobacco industry is going to fail, it's not going to fail anytime soon. However, I am concerned with Universal's growing debt load, with over $1.4 billion in total debts, including $360 million in short-term debt. Rising interest rates could pose a serious problem for Universal, given its growing debt load and relatively flat revenues. For this reason, I am personally staying away from this Dividend King, but with a forward yield of 6.08%, the stock may prove attractive to some. Coming in at number 1 on the list of highest dividend kings is Altria Group, stock ticker MO. Founded in 1847 by Philip Morris, Altria is also involved with the tobacco sector, owning the Marlboro cigarette brand, as well as several chewing tobacco brands such as Skoal and Copenhagen. Additionally, the company has a 10% stake in global beer giant Anheuser-Busch, as well as large stakes in vaping products and in the cannabis company Kronos Group. What I like about Altria is that they have diversified their holdings out of being solely a tobacco company. Vices never really go away. They just mutate into other forms. And with Altria's cannabis and vape products, they're well positioned for this change. The stock price of Altria has suffered in recent years, in part due to potential bans from the FDA on e-cigarettes produced by Juul Labs, of which Altria holds a 35% stake, valued at $12.8 billion at the time of purchase. Stock prices quickly suffered as Altria was forced to write down the value of this investment. And from a share price perspective, I believe that Altria shows significant value, especially when we compare the forward PE ratios of Altria versus similar Philip Morris International. We see that Altria trades at an astonishingly low 8.7% forward earnings. As a whole, the tobacco sector averages an 11.65% forward PE ratio, indicating that Altria may be significantly undervalued, especially considering its diverse holdings into alternate products. And to make things even better, 2 weeks ago, Altria announced the acquisition of Enjoy, an e-vapor company expanding its lineups outside of traditional tobacco products. Unlike the Juul e-cigarettes, these e-vapor products have already been approved by the FDA for use last year. With vaping becoming an increasingly trendy option, particularly amongst America's youth, The addition of these vape products will likely provide significant growth and revenue opportunities for Altria, and these growth opportunities are crucial for an otherwise flatlining tobacco industry. This, in addition to its stunning 8.14% dividend payout, makes Altria an easy choice for many dividend investors. But what are your thoughts? Leave a comment below with which Dividend King you are currently buying. If you enjoyed this video, consider subscribing, and as always, I'll see you all again next time. Thanks.